When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Vogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Vogan. And now here's Jeff Vogan and Jeff Shade.
Thanks so much. Welcome to Premier Retirement, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about news stories that could affect retirees' money over the next decade. We'll also answer listener questions and finally, why so many Americans think that they can't retire and what to do about it. My name is Jeff Shade. As always, I'm just here to ask the questions with the words of wisdom and solid advice. They come from the other Jeff in this radio program. It's Jeff Vogan, founder and president of Premier Retirement Planning and Wealth Management. Jeff, how you doing today?
Doing great. Always fun to be with you on this weekend.
And it is the same here, Jeff. Always glad to be with you. You know, you've lived here for quite some time. I haven't lived here as long as you have, but I'm waiting for the license plates to go back to where they were. I'm tired of this traffic. When does that typically happen?
Oh, it's starting to happen now. I think there's still a little bit of rush hour in the busy times, but I think by the end of April, mostly a lot of people stay here, do their taxes, and then the winter visitors will start leaving as soon as it hits 100, which
it's going to be.
We're getting there now.
Yeah.
So, you know, I think that kind of, the shock came this week. We finally had a hot week. And then I think it's just going to get a little bit busier from here. It'll cool down 1 week in May. It always does. And then it's off to summertime.
Anyway, Jeff, of course, we're not here to talk about the weather. We're here to talk about finances and retirement and investing and all that sort of fun stuff. So let's start off by talking about some news stories that could affect retirees' money over the next 10 years. There's a lot happening in the world right now. Geopolitics, we've got inflation, interest rates. A lot of people approaching retirement are wondering how all this affects their money. So let's start with a big geopolitical story. Of course, tensions in the Middle East and Iran and concerns about oil supplies. Why should retirees care about that?
Well, if they have to drive someplace, obviously gas is going up. I think it's interesting that gas has spiked even before any of that oil has even been priced into the market. It's just basically anticipation. And I think, honestly, price gouging. I get it that these oil companies know that they're going to have to buy oil at an exorbitant price. You know, instead of $60-something a barrel, it's $100 possibly a barrel or more. Too many companies, because I guess they figured the world was a safer place and there wasn't going to be something like this happen. Very few companies have hedged. Most of the airlines have not hedged with buying futures for their fuel and oil and stuff. So there's some problems happening there with travel. There's a lot of companies, energy companies that are in the business of distributing oil and gas are also, some hedge and some don't. The ones that have hedged, their stock is doing very well because they're locking in lower prices and they're able to charge more. So other companies, I think, are kind of like smacked upside the head and are kind of jumping the gun as far as, and trying to protect themselves by raising the gas price. I couldn't believe I paid for the first time in I don't know how many years since I paid over about $5.30 a gallon for the premium. And this was at like Fry's or Circle K, one of the places that's usually cheap. Kind of surprised that it spiked that high, even though it's only been a week or two since I've had an oil problem. The thing that also kind of gets me is we as Americans only rely on Iranian oil to like 1 or 2% of our oil supply. So it's a very small number, even though 20% of the world oil supply comes out of Iran and the Strait of Hormuz and so forth. But a lot of South American countries that don't get it from Brazil or Venezuela, you got China, a lot of European countries are very dependent on that Strait of Hormuz oil, the Iranian stuff. So I think that's why Trump's asking them for help. Hey, look, we only get 1 or 2% from here. It's not going to really affect us long term. You get all your oil from here. So maybe you ought to park a boat out here and try to keep your ship safe. And I think there's been some progress made as far as keeping the oil flowing, even though I think there was a knee-jerk reaction at first. I don't know that we'll see $120 oil. I think we'll see more expensive oil for the long term, but I think it'll probably shake itself out fairly quickly. I'm hoping so. I'm trying to be optimistic. I don't like any idea of war, but I also don't like getting nuked by a bunch of radical wackos that Bill Obama want to drop it on us and has been saying that they will when they get it soon. And if we found out that they have enough enriched uranium to build 11 nukes, that's taken out Israel and a lot of the eastern seaboard of the U.S. probably. So I think the preemptive strike was probably justified. I don't have all the intel that they do. I assume that the president does. And I'm going to have to give him the benefit of the doubt. I'm not happy about oil. I'm not happy about any type of war. I'm not happy about the division it creates. not happy about the angst of wondering if there's terror cells in the U.S. that might retaliate. Obviously, nobody wants that. But then again, if we did nothing, it could have been worse. I hope that's the right answer. But bottom line is prices have a tendency to go up in a wartime or in these times of uncertainty. And I think we're certainly in a time of uncertainty. We've been for a while. We've seen the market being propped up by, I think a lot of it's propaganda and Wall Street games. But sometimes it takes a catalyst to shake the market and see if it's really okay. And we've seen energy stocks move up pretty good. I'm surprised we haven't seen silver and gold really reverse its trend in a strong way. It seems like it's just kind of stopped or impeded the downtrend a little bit. But I think over the last few weeks or month or so, which usually a hedge during times like these, the gold and silver market, or even all precious metals, seems to have taken a pause and not really doing super well. Still, in my opinion, in a down or sideways trend. So not sure if we're going to get that resumed uptrend or not. I think most of the smart money is probably moving to oil and energy. Sometimes the shipping companies that aren't getting battered by the potential of the Persian Gulf War issues are probably going to see some growth because they'll be delivering oil from other parts of the world instead of through that area. So there's opportunities, obviously, in investing if you follow the money and see what's going on. But as far as cost of goods sold and stuff like that, if price of energy goes up, then it filters through just about everything. So we may see some, maybe not a spike in inflation, but I think we might see some inflationary pressures, obviously. And it's never fun. So not just for seniors, but for our kids and anybody trying to buy gas and exist in this, what has become kind of an overpriced America compared to what we've had recently in the recent past. But nevertheless, comparatively to the world, we have a super high standard of living. We have a super low cost compared to the average earnings, the average income, and the cost of the lifestyle that in other countries only kings and queens and royalty live. We get to live here even in spite of a little bit higher oil, a little bit higher food costs, a little bit higher everything costs. And I think we just need to count our blessings and hope the government's doing the right job by deterring evil and deterring what could be bad things for America, including massive death toll from radical people that are willing to use a nuclear bomb to get rid of us. Anyway, that's kind of my take. We'll see how it shakes out. I'm not scared yet, still dabbling in the market. We gave back some more profits that we've had year to date, still ahead of the game, and the indexes are all down. So, there's still opportunities. If we look for them, we follow the money, still doing that. And this past week, looked like things stabilized a little bit and we had a few good days. So I don't know if that means it's a dip and we're buying the dip or if it's the start of something bigger, but we're keeping an eye on the market. I think the market usually tells what the sentiment is. And I think there's more sentiment that it's not going to be overblown, not going to be protected, and not going to be economically devastating, or we'd probably see a bigger sell-off in the market right now. So with that said, I'm still sleeping at night. I'm not worried. I still get up early and check the market, check the news, obviously, but I don't worry. I don't lose sleep. And, if you have your money, since we're talking about money, if you have your money diversified into things that are principal protected, things like this shouldn't matter. But if you have all your money in the market and have not taken some great profits over the last few years that have been dealt to you in, I think, undeserving fashion, but it has been because the fundamentals certainly don't support what the market's done and what investments have done for most Americans that have savings. You never get hurt taking profits, and it might be a kind of a call to take profits, maybe reshuffle the deck a little bit, and to move some of those profits off the table into principal protected accounts. We like LERPs and we like FIAs, the fixed index annuities. They have principal protection, they have upside. They don't get scary during times like these. They just get more popular, actually. And people are really glad when they look back that they had done something so that they're not dealing with 100% of their money in what we call scared money assets, where these uncertainties rock your world and make you wonder if you can continue to retire on your terms, continue to last the next 20 or 30 years or however many decades you plan to retire and not run out of money. But, a lot of good market upsets or a few big ones can derail the best of intentions in a retirement plan. And that's why you have to protect assets, protect your life's work, and make sure that when times like these happen, you don't lose sleep. You say, oh, well, we've done our job. We went to Premier. We got a plan. We know that Jeff's watching the market. We know that he put us in safe assets that aren't going to lose money when bad times come. And that's really what our goal is. And I think if we've followed that plan, we're not worried. The only people that have called me lately, in the last few weeks, are brand new clients, because in the past, that was an issue. It was a big deal. And I have to just kind of cool the jets and say, hey, let's talk them off the ledge a little bit. It's not a big deal. Remember, you put 3/4 of your assets in something that doesn't matter with the market. Remember, you have all the income you need for the next 30 years. It doesn't matter. You're okay. Sometimes they scratch their heads and go, well, I can't believe it. We never had this before. How did this happen? Why? What was different about the last couple market crashes that made my gut hurt? And why are you telling me I shouldn't get worried about this one? Well, I have to kind of reiterate why we're doing what we do. And that is protect your life's work, make sure it creates enough income, make sure there's not more risk than you can handle, And if you can handle risk, if your portfolio was up 10 or 12% over the first couple of months and you lost 4 and you're still up 6, are you really upset? Or are you scared? Or does the fact that it retracted 4% and we're still ahead of the market, does that bother you? Well, if it does, then maybe you do have too much money in the market. You can take advantage of the blessing that you got from being a little bit more risk-oriented for the last few months, maybe take some of that profit off the table. But if you don't feel comfortable with it because profits come and profits go, if that still makes you sick and uneasy, then you probably have too much money in the market. So it's a good time to reflect and to make sure that your risk tolerance is equivalent to your risk exposure. And, it's good that we have times like these every once in a while. It kind of gives everybody a reason to reflect and to reevaluate their situation and make sure that they're set up so that if it does become a more serious matter, or if there is a more serious matter in the future, that they're in a position not to get hurt.
Talking with Jeff Vogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa, and we're talking about current event stories that could affect retirees for the next decade or so. If you're interested in what Jeff is talking about, you'd like to sit down with Jeff and have a one-on-one conversation about your individual journey towards a confident retirement, you can do that. It's called the Premier Retirement Roadmap, and it's absolutely no cost and no obligation to you. 520-780-9059 is our telephone number. 520-780-9059. Again, no cost, no obligation. It's just a one-on-one casual conversation. All right, Jeff, let's continue our conversation here. The Fed is signaling that interest rates may stay higher longer than people expected. Is that good news or is that bad news for retirees?
Well, it depends. If you want to borrow money to buy stuff, it's bad news. If you want to make more money because you're a good saver, not only are CD rates probably going to maintain that 3 or 4% level, which keeps up with inflation, which means you're making enough in interest to continue to cover those increasing costs. Or you've also got things like the LERPs and index annuities that we like, which are based on a fixed interest rate. If it's higher, the insurance companies that offer those products are making more money on your money. They can leverage it better and you can make more. So while we hate interest rates increasing the cost of food, we hate inflation, which is not really spiked, but it isn't as cooled off as we had hoped. It never really got down to 2% or below that, kind of hovering in that 2 to 3% range. And with oil going up, we're probably going to see a little bit more inflationary pressures. Typically, that means interest rates will go higher to try to cool off the inflation because easy credit makes it easier to buy more stuff and drive prices up, especially if there's limited supply or some of the things that could happen. If this Iranian, Israeli, Middle Eastern war situation gets a little bit more out of hand. Hopefully it won't. Bottom line is, if you're a saver and you can make more interest, you'll keep up with it. But if you're on a fixed income and don't have a lot of money that you can invest at these higher rates, then it's going to hurt you. So if you're on a fixed income and your Social Security is growing and they give you a 2% cost of living increase, but the stuff that you buy is actually going up 4 or 5 or 6% because it's food and other things, even though housing and computers and stuff that you're not really in the market to buy might not be going up as fast, making the overall inflation rate look lower than it really is to you personally, for example. You might find that the inflation and the fact that they're raising interest rates hurts you. I think it's going to hurt more the people, our kids, the next generations that are behind us and grandkids. I mean, if they want to buy a house, they want to borrow money for college, they want to just buy stuff. Credit helps the economy. I mean, it helps create purchases now rather than later. And obviously, if you've got earning power and can pay those purchases back, companies sell more now instead of later. They get to put that money back into the economy now instead of later. So it creates a better world for everybody. I don't hate credit. I think it's really what built America and built our economy. Unfortunately, people have abused it. People get a little bit too overexuberant using it. I mean, people are borrowing 2 to 3 times what they own in their stock portfolio against it to buy more stock, and which is part of driving the market up to what I consider historically unreasonable values. But nevertheless, it is happening. So we can blame easy credit for the growth in your own 401k because other people are buying those stock prices up. You can blame, inflation for your own good economy, the fact that you were able to retire with a bunch of savings because the economy grew much bigger than it would have without it. So the price of credit being low is economically good. It does create inflation, however, and there has to be some sort of a balance. And I think the Fed's biggest job is trying to balance that. And the fact is that they only get the information after the fact, and they're always reactionary. They're never proactive. They're never preventative or maintenance mode. It's always, oh, gee, what happened? Now we have to do this. And it's typically late to the party. And I don't know that it really accomplishes a whole lot. I think Fed's really just a pawn for the Rothschilds, Vanderbilts, and all the rich people that run the world so they can control banks, credit, and their own wealth rather than the world's wealth. Nevertheless, the pawns and the peons and the serfs and the peasants in the world have to feed the kingdom. And, I talk kind of like this as old medieval times, but there's still a big group of powerful people that run the world and kind of control the Fed, control credit, and Sometimes they have to make some changes and some adjustments along the way. Sometimes they're good for the rank and file middle class person, the Main Street person, and sometimes they're not so good. But rest assured that they're pretty much always good for those rich and elite class that run things and have most of the wealth. I mean, they like inflation. I mean, if you're a rich person and you have even an art collection or a car collection or a bunch of real estate and even stock market, I mean, you love inflation because it makes your wealth grow even faster than if there wasn't inflation. So there's that kind of happy medium place that we have to go to, where we have to get to a place where we can really stimulate the economy with low interest rates. But then when it's time to take profits, I think the big money allows things to go up and they don't mind inflation. Inflation helps their net worth and they're not out looking to buy stuff on credit. They've got cash. So it's kind of speaking of classes, the rich class and the poor class, the middle class, which is becoming more poor comparatively, there's a bigger separation as we go. And a lot of that is because of some of the inflation, higher interest rates not being compatible with the people's ability to buy things on cash, having to borrow in order to get ahead. It's just a little bit different time than we've probably been in the last couple of decades, but it's probably more of a time reminiscent of what was 30 or 40 years ago when rich people got along fine and the struggling class struggled until they could finally get a house and they could finally do things. It got easy for a while and it's not as easy anymore, but it doesn't mean it's bad. It just means it's not as easy. It means we got to work a little harder, work a little smarter, save a little better, take advantage of the interest rates on your savings and the investments that you make, but don't get caught up in maybe having to overborrow at a higher inflated rate. That might hurt your ability to grow and to develop wealth and create a retirement plan or stick to a retirement plan if you already have one.
Talking with Jeff Vogan on Premier Retirement Planning and Wealth Management. We're talking about current events and things that could affect your retirement here in the next decade. Again, our phone number, 520-780-9059. It's 520-780-9059. If you'd like to get in and sit down with Jeff, have a casual conversation about these and anything else that might affect you and your retirement going forward for the next 10 years. Jeff, I want to talk about artificial intelligence. It's become one of the biggest economic stories of the decade. How do you think that AI is going to affect retirees here in the next decade?
Well, I think it's creating awesome opportunities, awesome economies of scale in some ways. It's creating probably more problems for the working class. We're going to probably have to change direction where technology can do so many things that humans had to do. I don't think it's going to take the humans out of the equation by any means because there's no emotional, logical, moral, or comparative thinking process with AI. It's just based on kind of a math algorithm. And if you base your life on math and take away all the other things that are important to humanity, it's not going to replace everything. The other thing is it's just due to the growth and the energy that it needs, the data centers that it's going to need, and all the processing. There's a lot of opportunity for those people that build those things. Plumbers and contractors, construction workers are actually going to be more needy, according to the experts, than they are now because of that growth. So maybe the people that thought they were going to get into the tech market that now has an AI person or AI thing bot doing their job might end up finding out they can be a plumber and make more money. So I'm maybe simplifying the deal a little bit, but everything that is economically efficient, and AI makes everything economically efficient, makes it quicker. I can get answers quicker through ChatGPT than I ever could by Googling it and just doing my own searches. It'll just search everything for me, give me the answers, and I can get on to business and work smarter, not harder. I can work less hours and do just as much production as I used to do because of AI. That means I have more time to what? Go out, play golf, buy things, go on vacations. Maybe I stimulate the economy because my business gets more efficient. I'm able to do more. I increase my revenue, my income. The business can reinvest in more stuff. I can go do more fun things and invest in more stuff. That creates a higher demand for maybe those services that I would be buying with that extra money. So I'm just talking about, and not just everybody, but now the person that was doing a certain service that more people can afford because they have more downtime because AI is making their work week shorter or more efficient. Now, those people that offer those services are going to have more income and they can go spend it on more things. So I think AI, every time we get scared about AI replacing jobs or whatever, we have to remember that it's going to increase the economy and the benefit of so many things. And economies of scale do not hurt anyone. They usually make the world as a better place better. I think if we sit and take a nap and don't get involved and look at the opportunities and seize those opportunities, we might be left behind. And I think there will be a class of people that are ending up, the homeless class or the poor class might be getting bigger because people are not motivated to either educate themselves in those areas that could be great opportunities for income generating businesses or services or getting the right job and the right career path in light of where this is going. And there's plenty of forecasting by experts that can tell us these things, and we can read about it. We can analyze it for our own self and find out what those best future careers are going to be and devote our learning, education, and our focus on those things that will leave us in a good place a decade down the road instead of in a bad place. I think some people are so happy doing what they're doing, where they learned it in a world that didn't even have AI in existence, now have to rethink their career paths because AI will probably eliminate many of them. And if those people don't adapt, they're going to end up being left by the wayside. So it's good and it's bad. And I think if we're focused and attentive, we can take advantage of the good.
So, Jeff, when you step back and look at all these headlines that we talked about today, what's the big takeaway for retirees, do you think?
Well, there's different forces that shape retirement planning. The plans that we've been doing for years are still going to work in this type of environment. The nice part about being a retiree is you're already done with your career. You've got your assets, and now you just have to make your assets work for you efficiently and create the cash flows you need, create it on a tax efficient basis. But I think from the standpoint of retirement planning, if you're still a decade or two away from retirement planning, you've got a lot of work to do to make sure that inflation, energy issues don't derail you, the AI issue doesn't derail you and make your job obsolete and make you end up having to look for a redirected career just a few years before retirement in order to make those goals financially. Interest rates might stay higher. So again, if you're buying things and trying to use credit, you may be pinched a little bit more. But then again, with AI efficiencies and some of the opportunities that are out there, maybe your income will go up accordingly. It's not going to be a big problem. Again, you need to make sure you analyze the world around you and don't just stay in a little bubble and not see what's going on. Government debt's still going crazy. Too many entitlement programs, in my opinion. Too many people have been too used to living on the taxpayer dime. And I think if they could get government a little bit more under control, I think it'll put the world in a little bit better place. Maybe we can pay a little bit less taxes. Maybe we can use more of that in productively economic beneficial things. And I think going forward, the main thing is never really changed is we need to make sure that our investments, as a retiree, you need to make sure your investments replace that income that you were so used to getting on a paycheck. Make sure that you've got some sort of a indication of inflation. Now, I will talk a little bit more about inflation, and I've mentioned this before, is the Wall Street world wants you to never to spend any money so they can continue making fees and hear that little cha-ching, cha-ching sound every time you move money or they rebalance a fund or whatever, because they make money on you having more money with them in the Wall Street firms, usually in the market. My opinion is you ought to spend that money while you're in your go-go years. But if you put it off, say, oh, there might be inflation, things might cost twice as much when you're 90. Well, things might cost twice as much, but you're only going to be doing about half as many things. So is it really going to cost twice as much? Probably not. It's probably going to cost you maybe a fraction more than it costs you now if you're actually busy spending money. So while we have to worry about inflation, you need to worry about running out of money before you run out of time or life. Yeah, just need to make sure that you plan and you have a structured plan that makes sense. And also that you build it with buffers so that when interest rates spike or when inflation hits a little close to home with gas and food and energy prices during hopefully a very short war experience with Iran or in the Middle East, hopefully it won't last long. Hopefully it won't be a big long-term thing or turn into any type of a world conflict, world war. If it does, then we have to rethink things and just be happy we have what we have and try to protect it even more. Bottom line is nothing's really changed in the last 20 years as far as how we plan compared to what we plan for now, because we always took these things into consideration. Inflation, what could happen with the economy with everything from energy, food prices, housing prices, or anything else. Interest rates, are you carrying things on debt that is variable that could change and hurt you? Well, if you're carrying big loads of credit card debt or you have a variable rate on a home or something like that, and you're still buying things on credit, then interest rate policy makes a big difference to you. But most people want to be out of that dependency on credit and on interest rates when they're using the money. They want to be more dependent on at least returning a fair rate of return comparative to inflation on the money that they have in savings and in growth. So again, it really hasn't changed. We still use the same 5 pillars of planning: investments commensurate with your risk tolerance, investments that create income to replace the income you used to make, save taxes as much as you can. Tax efficient income is more important than risky income that's volatile and goes all kinds of crazy regardless of how much you make if you just throw away a third of it in taxes. Then what happens if you have a healthcare crisis? Do you have a nest egg for that? Do you have a plan for that? And then how do you want to leave your assets to the people that you love with the least amount of trouble, taxes, probate, all those other things you want to avoid? Those are the 5 pillars of planning. They've never changed. They're the same today as they were 30 years ago when we started focusing on the client first and building comprehensive plans. So just because things change doesn't mean the planning changes. It just means it affects your plan a little bit differently. And if you've balanced it out, you've already got a buffer that will handle some of these shocks that come along.
Great information, Jeff. Want to talk to our listeners here for just a moment. If the news lately has you wondering whether your retirement plan can really handle inflation, market swings, and rising taxes, right now is the time to find out. Jeff Vogan and the team here at Premier Retirement are offering listeners a complimentary retirement roadmap review. They'll walk you through your investments, your income strategy, and your tax exposure to help you see if your plan is built to last through the next 20 or 30 years of retirement. There's no cost and no obligation, but you do need to schedule it. Call 520-780-9059 right now to get your Premier Retirement Roadmap absolutely, again, no cost and no obligation. That number once again, 520-780-9059. We look forward to talking to you. Jeff, time for a break. We come back here on Premier Retirement. We've got listener questions and more when our show continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Vogan and Jeff Shade.
Thanks so much for joining us. You're listening to Premier Retirement with Jeff Vogan. My name's Jeff Shade. Glad you could join us again this week. Want to remind you once again, we are on the air for you 4 times a week on Saturdays at 7 a.m., 9 a.m., and 1 p.m., then on Sundays at 11 a.m. If none of those are convenient for you, as always, you can join us in our podcast. We've got a lot of shows up there, more than 100 past shows. You can take advantage of the opportunity to hear those shows by going to wherever you get your podcast, searching for Premier Retirement with Jeff Vogan. You're going to find this show and all of our past shows so you can stay on top of your journey towards a confident and hopefully a prosperous retirement. And if all that fails, you can also Google Premier Retirement with Jeff Vogan, and it'll point you towards any number of ways to hear our fine radio program. Okay, Jeff, always fun to hear from our listeners. We're going to start with Michael listening to us in Sabino Canyon. Michael says, I'm 64, married, and looking to retire this year. I have about $2.8 million in a 401k, stocks, and real estate. Instead of just focusing on investments, what should a complete retirement game plan, or as you say, retirement roadmap, actually look like for someone with significant assets?
Well, I mean, assets are assets. Significant or not significant is a good number. I think it's significant if you have enough not to run out of money, if you structure it correctly. Some people that have a super high lifestyle, 2.8 million wouldn't be significant. If you're a doctor living on 600,000 and that's all you got saved, you're probably not going to do very well in retirement if that's what you're. I should call out doctors. It just seems sometimes their income, when it goes from high multi-six figures to a retirement plan, sometimes it's harder to make ends meet. But there's kind of a rule of thumb when somebody's your age. If you're making about $250 a year and you have 2.8 million in a 401k, you should be able to live on pretty much the same lifestyle. So kind of like about 10 times the amount. And having built thousands of plans over the years, I would say that you're in a place where you could probably, if you're making $250 a year, you're probably only living on $150 to $160 after you pay taxes, Social Security, all your benefits, union dues, whatever else comes out of that. You can still consider a high $150,000 to $200,000 lifestyle would probably be reasonable if you don't risk or lose all your money. I mean, the first time the market corrects, well, if the market corrects 50%, and by the way, fair market value historically is about half of where the S&P is right now. So if it were to go back to equilibrium, by the way, when there's a big crash, it typically goes below that first and then comes back. If you're spending money during that time, you're going to lock down losses. I mean, consider what would happen if something happened with this war and it became a big deal and all of a sudden the market went down 50%. Your 401k is worth 1.4 million. I would just say you better cut your retirement plan roughly in half as well. So I think significant assets, you do have significant assets if you take the profits off the table. And if you want to build a plan that uses that 2.8, I would do the same thing as I would do with somebody that has 400,000 or 28 million. Is how much actually 28 million would need a good estate plan, meaning a estate tax plan. So we'd build some trusts and things like that we wouldn't necessarily build for you from a tax standpoint, but from the standpoint of income standpoint, we would still divvy it up into how much of this do you want to risk, how much are you willing to lose or wait on, and how much of it would create that income that you're used to getting. I had a similar situation that I talked about in some of my seminars and meetings. We have a story that we changed the name to John and Deb, but it was a person that had a little over $3 million in assets. We're making about $250 a year, so maybe a little bit more savings, but very similar to probably where I think you probably are. We moved around the money. All they wanted was at least $150,000 to live on. But once we moved the money into a fixed index annuity account, about $1 million of it, that generates about $75,000 a year in income now. And we moved a little over $1 million into Alert, which generates over $100,000 in tax-free income, plus a Social Security, and another $800,000 or $900,000 that's just sitting in a Roth that they're not even using. Now they're able to actually live on $200,000 to $250,000 rather than do what the Fidelity website said when they were getting ready to retire 7 or 8 years ago, that a safe amount to spend would be about $150,000. It would basically create $150,000 a year lifestyle because all their investments were in a 401k and were volatile, that had stocks and bonds in it. By the way, bonds, if you look at the 20-year bond, it's still down 30 or 40% below its high a few years ago. So you can lose money on bonds. If you're spending that money, you're locking in losses, 30 or 40% losses compared to what you could have taken off the table a while back when the bond market was peaking. So again, you never get hurt taking profits. The stock market fell. Some people got scared, went out to the sidelines, didn't get back in until recently, and now they're getting back in at a really high period of time. Volatility would kill that plan if you're not careful and if you don't take some of those profits off the table. I would say 2/3 of that could easily be put into an income stream that would guarantee you $150,000 or more in long-term income, and you have $800,000 to play with. It wouldn't matter if the market corrected 0.5%. You'd lose $400,000, but you'd still have all the income you need. And you wouldn't lose $400,000 unless you sold it, and you wouldn't sell it because the market does always eventually come back as long as you don't need that money to live on a month-to-month basis. You don't need to tap it for a emergency expense and things like that. So I think just structuring that out kind of in just rough numbers, if 1/3 of that was devoted to tax-free income and the rest was devoted to just pay-as-you-go kind of strategically placed income, we'd probably do some heavy-duty conversions, pay some taxes over the next 4 or 5 years, and then hopefully we can get your taxes, even though you're living on more than $200,000 a year, we could get your taxes to a 12% bracket, which is more like somebody making around $100,000 or less per year. So those things are all possible. That's how we do our plans. I think you'd find probably $500,000 or more in tax savings if you did it our way. Over the next few decades, you'd find out your income would be about $50,000 a year higher than it would be if you use the typical rules of thumb in a Wall Street product. So you're going to live on maybe an extra $1 million over your lifetime, save about $500,000, maybe $1 million in taxes. You're going to be better off with a plan and protection, probably to the tune of a couple $1 million better than if you just kind of went on it and let the market go up and down and you locked in losses when it was down and you took advantage when the market was high. But bottom line is volatility will kill an income plan. It'll probably leave you with less net worth when you die than if you lock in gains, use principal protection, and make even a lower rate of interest or a rate of return over time, but manage it better. You'll end up with more money over the long haul, pay less in taxes over the long haul, have a lot more peace of mind knowing your bills are going to get paid every month at a level that you can expect, much of it guaranteed, much of it very predictable, and very little of it at risk, and what I would call in the scared money type of accounts. And believe me, those accounts get scary when the market falls, like it did with the COVID crash. Everybody wasn't sure if it was for real or not. And of course, the people that waited go, yeah, I told you so. People got out. There's holy smokes, I got out because I couldn't afford to lose more. There's no way I could have done it different. So everybody has a different risk tolerance. I think when you're retired and don't have that paycheck, you might find that you have a slightly different risk tolerance than you're thinking you have now, because you've been able to take advantage of the market and the good times. It never hurts you to count your many blessings and take the chips off the table.
Michael, thanks for listening to us in Sabino Canyon. Once again, if you would like to further this conversation with Jeff, call 520-780-9059. You can also find out more about the firm online, by the way, at premret.com. And we look forward to talking to you. Next question, Jeff, is David hearing us in Stone Canyon. David says, how do you stress test a retirement portfolio or plan to make sure it holds up through inflation, market downturns, and rising healthcare costs?
Well, David, if you're a golfer, you ought to meet me over at the clubhouse after a round. And
we'll talk about it
while I'm up there checking on our new home and stuff. Anyway, how do you stress test it? You can stress test it with all kinds of software that basically gives you random rates of return. We have a thing called Riskalyze. It's actually called Nitrogen now that gives you like a risk number. But honestly, you can't really tell what is going to hold up through inflation or not, market downturns or rising healthcare costs, because volatility hurts you during any of those times. Inflationary times, we saw volatility in the market in 2022 when inflation was hitting 9%. Market downturns, you don't want to take money out when the market's down because that's locking in losses. It's the only way you lose money is you buy high, sell low. Or you don't take profits when it's high and you end up selling low. That's bad. Rising healthcare costs, well, we like LIRPs, life insurance programs that not only provide tax-free income that you can get, but also provide a death benefit that you can use for those rising healthcare costs if you should become disabled, terminally ill, or need nursing home care in the future. That's the big cost that Medicare doesn't cover. Yeah, if you have a plan where you don't lose money on the assets that you need to provide income, and you have an asset class, even maybe it's a health savings account or something like that can grow tax deferred or tax free until you need it for those healthcare costs, you can cover inflation. Social Security builds a little bit of inflation protection into their annuity, the Social Security annuity. And market downturns don't matter what inflation is doing, what your income is, they don't care. It's just going to do what it does. And if you need that money, you're going to lock in losses. So we don't want you to do that. Like I said, we have kind of a Riskalyze type. It used to be called Riskalyze. I keep using it, but a risk test that'll tell you if you're taking more risk than you need and what the chances of you running out of money are if we have random returns like it's happened in the past, and kind of give you an idea of that. But once you see how we build our plan on a spreadsheet, Once you have all your needs, the paycheck money covered through guarantees, and I would still consider Social Security guaranteed. I just can't imagine that's going to go away. It might be adjusted for means testing or something like that, but it's still a pretty secure, guaranteed retirement plan. Maybe you have pensions, and you can also buy guaranteed, even stronger, I think, than Social Security, stock market, and other things, through annuities with insurance companies that are super strong, that have a reserve, have surpluses, have extra assets, more assets than you need, plus insurance backing the insurance. And there's, in my opinion, no risk to those type of assets, and we can call them guaranteed and we can call them safe. They are not called securities, by the way. Securities with the root word secure are not secure. So don't get misled by that. And it was an oxymoron or just a play on words or just kind of a brain tease by calling anything with risk a security. But CDs don't have risk, annuities, fixed annuities don't have risk. IUL only has risk based on the cost of insurance and things like that. But there are ways to contain those costs, give you a sense of confidence and reliable income where you don't have to worry about all these stresses. And when you run that scenario back through the stress test, or look at a historical return of what would have happened had you had our portfolio versus a market portfolio and took income from it, you'll find out that much lower risk will generate more income, more peace of mind, more confidence in retirement than something that's still market-based. And Wall Street doesn't want you to know that, but the math proves it. I'm not just an anti-Wall Street guy. Shoot, we use Wall Street. I'm up at 4:35 every morning doing Wall Street trades for our portfolios, and we do very well at it. So I'm not opposed to the stock market. I love the stock market. I just loving having less in it and swinging for the fences with that money so that you don't have to worry about if the market takes a hiccup or a breather, that you aren't relying on income from that particular part of your portfolio. And that allows us to have a lot more confidence, maybe being a little bit more aggressive, because we know it's not going to affect your livelihood, your peace of mind, or your income plan if the market takes a turn for the worse. So again, it's just a matter of balancing responsibly, being diversified, not just with 100 different stocks in your portfolio, all of which could go down at the same time if the market takes a dump, but having assets in different asset classes, different tax categories, tax-free income. We love tax-free income. I don't know if you do, but I do. And tax-deferred income, that even still gives you some predictability and some planning for taxes and income and cash flow. And then we can also balance our taxable income into fixed income streams that don't go up every year like a required minimum distribution would make you, but basically put your income tax situation in a predictable fixed area where we already know what your taxes are going to be over the next several years, and with very minor adjustments or fluctuations involved if you plan correctly. So come stress test it, look at the income plan, and you'll find out you probably aren't really that worried about a stress test when you know all your needs are met. And then with less of your money at risk, you can be a lot higher risk than you could if you just tried to look at an overall portfolio and a comprehensive plan and what the risk number is on that plan.
David, thanks for listening to us in Stone Canyon, and look up Jeff there at the Country Club. We appreciate you listening to us. And if you want to further the conversation, if you don't meet Jeff in person at the club, 520-780-9059 is the number. I'm sure that Jeff would love to talk to you. Rick is in Rita Ranch, and Rick says, is it better to build a strategy around guaranteed income sources first, or focus on growth and flexibility and then adjust later?
Well, it depends how old you are. If you're 65 and already retired, it's time to talk about income because you're not getting a paycheck anymore. So you already did the growth and flexibility. If you're in your 40s or 50s and have some time, then yeah, let's work on some growth. Let's also lock in some of those profits that you've made along the way and maybe create a situation that will guarantee future income on that day or time that you decide that you want to retire and have income. So, I mean, it can all be done simultaneously. I think even in retirement, there's a portion you got to set aside for growth and some fun and flexibility. We like the excitement of the stock market and the upside that it can provide. We also have to respect it and know that it can dish out devastating losses if you've got everything in that bucket. So let's do it responsibly, build a strategy around guaranteed income. I think that's the main thing. If you're building a retirement plan, we want to make sure that the income needs are met first. We want to look at that, whether it's future or current, and make sure your bills are paid. So we call that paycheck money. We call playcheck money the growth and flexibility money. So yeah, I think your question is right on the money from the standpoint it's best to build a strategy around guaranteed income. But again, if you're still in your 40s or 50s and haven't gotten to that retirement age yet, maybe just growth. And as you get a little closer, then you decide, okay, now if we start taking some money off the table, how much income is a realistic number for us to plan on in retirement? I mean, you don't really know over the next 10 or 15 years what your employer is going to do for raises, if you're going to find a better job. If you're going to lose your job, maybe you have to rethink your career path. Since we don't know, I think just being a real aggressive saver, living within your means, always taking the match in the 401k, saving whatever extra you can, maybe sacrificing a little now for some more guarantees in the future wouldn't be a a hard thing. I know some people say, well, I'd rather travel and spend all my money before I'm retired because when I'm retired, I might not be able to do that. I'd rather live poor in retirement than poor during my growth years. Well, you can probably find a happy place where you can do a little bit of both and not be worried in retirement. And you might find out that you probably have plenty of go-go years left when you're not working 40 or 50 or 60 hours a week and wish you had a little bit of money for it. But again, a good plan will give you some clarity or at least some predictability as to far as where you'll be. You're never too young to start a retirement plan, to at least look at the future and see what it looks like. But if you're getting closer and closer to it, it's probably better to have a pretty regular, at least annual review or every couple of years if you're getting closer, to just kind of test and see where you're at and see if that income plan for the future looks like it's still intact or not. You're never too early to start planning, but as you get closer, it's probably more important to really be focused on it and have more reviews and more understanding about where you're going to be in the next few years.
Rick, thanks for listening to us in Rita Ranch. And again, if you'd like to further the conversation with Jeff, 520-782-9059 is the number to call. And of course, you can also find out more about us online at premret.com. It's PREMRET.com. Jeff, I want to take just a moment once again to talk to our listeners. If you're within 5 or 10 years of retirement, or you're already retired, the question isn't how much you've saved. The real question is, will your money last as long as you do? I mean, between inflation, market volatility, rising healthcare costs, and uncertainty around Social Security, retirement today requires a real strategy. That's why Jeff here and the team at Premier Retirement are offering listeners a complimentary retirement roadmap review. They'll help you see how your income plan, your investments, and tax strategy all work together and whether your plan is truly built to last. 520-782-9059. That's the number to call right now to schedule your Premier Retirement Roadmap at absolutely no cost and no obligation. It's 520-780-9059. We look forward to talking to you. Jeff, a lot of people love the idea of retirement, but they hate the uncertainty that comes with it. And surveys show that more Americans are delaying retirement. Do you think that people really want to work longer, or is it something else that's going on?
Well, I think it's a fair question. I mean, a lot of people are worried about it. Some people didn't kind of get to the savings program early enough and kind of should have. And some people have really learned to live on a large budget and haven't saved, and they probably aren't going to be able to retire, at least not in the lifestyle that they had dreamed about or had hoped for. It's funny, though. I see more people that are worried about running out of money that have actually been very good savers and I can't even see a situation where at their spending levels or at their retirement goals that they could possibly run out of money, yet they're still worried. So it's a common worry. I mean, when you don't have a paycheck paying the bills, I mean, it's worry enough just knowing if that paycheck's going to be continuing during your working lives. But when you don't have a paycheck and wondering how that income or that money that you've saved is going to create an income stream, yeah, I can see where that's kind of a daunting thought and could certainly take its toll on your mental stability a little bit. So 51% of retirees fear running out of money. I'm surprised it's only that many. Probably 51% I've heard don't even have $10,000 in savings. So they're already going to run out of money. So I think that's those 58% of people approaching retirement, supposedly even more. But I think the people that are retired kind of have already settled in to know, well, this is my budget. I better deal with it. I've got to make do. But the people that are going into retirement, I think they just don't have clarity on how much they can spend or what they think they want to spend, if they can spend what they're used to spending. Some are scared enough to just delay retirement and keep working because they're scared. I've had, I'd say probably 25% of the people that come in their 60s that are probably a few years within retirement. In about a fourth of those cases, I would say you could actually retire and get a pay raise right now because they've been good savers or because they can turn a pension and kick on and make most of their income back. They can add Social Security to that and start living on distributions from IRAs, annuities, 401k money, and so forth. So if you just come and do the math and you find out that you can retire right now and be okay, then working extra might be actually fun for a change. You can actually enjoy working. I've been working because I want to for a while now, not because I have to. And I'll tell you what, it's more rewarding. I enjoy my job more than I ever have enjoyed it. And again, it's not because I need to. It's just because I want to and I like it. There's no pressure. I don't need another client to be okay. I love helping people. And the funny thing is as soon as we haven't really been pushing the issue and needing new clients to keep the lights on, life got better and business got way better. So it's just the lack of pressure and just the ability that I can just focus on clients and things instead of wondering about my own retirement. I mean, that's just me putting my own perspective in it. I can relate to that because I know a lot of people are in that position where, do I keep working? Well, I don't know. If you want to justify to your spouse why you ought to be buying something that they think is stupid, then you ought to keep working. That's my opinion. And I just say that kind of tongue in cheek, but that's what some people ask me, why you keep working? I don't know. I might want to buy something stupid. So yeah, I can justify it. Maybe retirement is coming and going as you please. And you may not want to ever quit. I've got clients that are working in their 80s. They love their jobs. And honestly, they seem a lot more healthy and they're aging better than most 80s that are retired, sitting around half the week and thinking about what their next trip's going to be and forgetting to exercise and maybe not eating right and never keeping their mind super active and so forth. So I don't think that's a detriment to working, but I think as soon as you work because you want to, not because you have to, you can consider yourself retired. You don't have to be considered retired only if you only have a paycheck and have to live on just your money. You should be retired as soon as you don't have to work. And the only way you'll know if you're there is probably just to put things down on paper, build a retirement plan. That's kind of what we've done over the years. Is probably half the people that come in say, I'm getting ready to retire. Do I have enough? What is a reasonable income plan? And that gives them the peace of mind to know whether or not they have to go back to work, or to know that they can retire or start living on some of their income or doing some fun things because they know they're okay. And again, it really comes down to, if you want peace of mind, just clarify the picture. If you don't have a picture or a plan, you don't know where the boat's going, yeah, you're going to be nervous. If you just go and get on a random boat that's going somewhere, you say, I'm going to take a cruise. I think I'll get on that boat. You have no clue. Aren't you going to be a little nervous? But if you know what the plan is and where you're going to stop and what you're going to do and how much it's going to cost, I mean, it's certainly a lot more comforting to have some sort of a plan in place or some knowledge about what the future might look like than just, well, let's see what happens. And unfortunately, so many people are, let's see what happens. And it's unfortunate that advisors out there are actually encouraging it. Oh, don't worry. Let us take care of it. We'll just see what happens. We'll let you know if you can spend more money. And of course, they say, don't spend money. Keep it in here so I can keep making my fees. Don't spend your money. Live like a pauper, even though you've saved a lot of money. Don't spend your money. I hear that all the time. I want you to spend your money because you know what I hate? I hate people coming in for their annual reviews and being sourpuss because they haven't been able to spend any of their money. I like creating a plan where you can spend your money, spend all the money that you want or need, have some left for your heirs if that's what you want, or spend every last dime if that's what you prefer. So whatever floats your boat, and make sure you're on a boat where at least you know where it goes. And I think you're going to at least be, I would say, of the 58% of the people that are approaching retirement without a plan, there should probably be 70 or 80% should be a little worried about it. But if 58% of them do, I'll bet if they came in for a plan, it'd only be like 25% maybe. Less than half of the people that are worried now would be worried if they put a plan on paper and saw what their money could do for them, utilizing the tools that we use: principal protection, income, tax savings, and efficient long-term income.
Jeff, another issue that people may underestimate and make them reticent about retiring is longevity risk and exactly how long retirement's going to last. Many people underestimate the fact that they may live 20, 30 years in retirement.
Well, yeah, maybe even more. They say that 10% of people that reach age 65 healthy could reach 100. So with technologies keeping us alive longer, just understanding our bodies and taking better care of ourselves will help you live a little longer. We always run our retirement plans out to age 100, no matter how old you are when you come in. But that is a fact. The biggest deal is the sequence of return. If you have risk, the more times the market crashes or drops down, if you're using market-related money, volatile money for income, the more often, the longer you go, the more times that has a chance to happen, the more often you're going to run out of money sooner. So that's why we love principal protection. We love the income annuities that are basically projected to maybe run out of money in your 90s. But the cool thing is the insurance companies will put a little bit of that money aside in the coffers in case you live too long. And if you don't live too long, you get whatever's in the balance of the account back. I mean, if you live too long, you keep getting income, even if the account runs dry. So if you have a plan that'll run you out of money at 90, but you live to 100, you still get that income. If for some reason you die in your 80s or you die at 90, there's still money in that account, then your heirs get that account value. It's not like you lose it like some of the old annuities. We like LERPs. The cool thing about LERPs is it's tax-free income, but because you're borrowing against the balance, you're not actually depleting the balance. You actually borrow money from an ever-growing, ever-compounding principal or account value. So honestly, as you get older, you can actually borrow more and more from it as that account continues to grow. So we like the fact that some of our income plans are very conducive to making sure you have the confidence that you won't run out of money, at least some of those assets. A lot of our clients have more than half, maybe even 2/3 of their assets into those things that create income, creates tax savings, and create a growing account that could possibly generate even more income the longer you live, rather than just run out and have you kind of stuck there. So we like balancing things out. We also like to put some money aside that we know you're not going to have to touch for a long time. We can invest that in the market. We can be aggressive with it and hope that in 20 or 30 years, it's worth multiples of what you started out with, even in spite of what could be market corrections and so forth. If we manage it correctly, like we've done in the past, we like to buy on the dips. We like to buy when the market's down, not to get scared and sell out. And the only reason you can do that is if you have the ability to know that all your bills are getting paid, so you don't have to be scared out of the market. You can always stay in it, and you can dollar cost average down. You can take advantage of the market swings if you pay attention and make money rather than lose money and get scared like everybody else. So yeah, outliving your money is definitely a big concern. Most people are scared of it, but with the way we plan, we take care of that. It's not going to be an issue if you live too long, if you follow the plans that we do.
Talking with Jeff Vogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. We're talking about those people who are afraid that they cannot retire. If that is you, you'd like to talk to Jeff here and see how you can retire, call us at 520-780-9059 and request your Premier Retirement Roadmap, no cost and no obligation. We will run you through your investment portfolio and we'll take a look at the future here. We'll run these plans out to nearly 100 and find a way for you to retire, maybe a lot sooner than you might think. Once again, it's 520-780-9059. You can also find out more about us online at premret.com. That's PREMRET.com. Jeff, out of time for this week. Thank you so much for your time. But most importantly, I want to thank our great listeners for joining us here at the Greater Tucson area. So for Jeff Vogan, I'm Jeff Shade. Have yourself a great weekend. We'll talk to you again next week right here with another edition of Premier Retirement on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage, Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy, and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.